Something big just happened in Singapore's financial scene and almost nobody's talking about it. HSBC, one of the world's biggest banks, just quietly pledged $1.5 billion to fuel Asia's startup economy. But this isn't just another investment headline. It's a power play, a move that could redefine who controls innovation in the post-Silicon Valley era. Because here's the thing. After Silicon Valley Bank collapsed, the global startup ecosystem was left scrambling. Now HSBC wants to take that chaos and turn it into dominance. Chapter 1. The Rise from Silicon Valley's Fall. In early 2023, a quiet panic spread across Silicon Valley. Startups couldn't access their funds. Founders lined up outside banks, refreshing their phones, waiting for a miracle. That's because the unthinkable had just happened. Silicon Valley Bank, the financial backbone of the global startup world, had collapsed almost overnight. For nearly 4 decades, SVB wasn't just another bank, it was the lifeline for innovation. It financed half of America's venture-backed startups. It handled deposits for companies like Airbnb, Shopify, and Pinterest back when they were just ambitious ideas on whiteboards. If you built in tech, you banked with SVB. It was almost a rule of Silicon Valley itself. So when it went down, the shock wasn't just financial, it was psychological. It signaled the end of an era where startups believed that money would always be there. Suddenly, one question echoed across the tech world. If the bank that built Silicon Valley could fail, who can you trust now? That's where HSBC saw an opportunity and moved faster than anyone expected. Within days, HSBC announced it would acquire the UK arm of SVB for just one, essentially, rescuing thousands of startups from collapse. But the real story wasn't the price tag, it was the strategy. Behind the scenes, HSBC was already assembling a new kind of banking division, one that would take SVB's playbook and rebuild it for a global stage. They called it HSBC Innovation Banking, and rather than starting from scratch, they did something clever. They hired dozens of SVB's top people, including entire relationship teams who understood the startup ecosystem inside out. These weren't traditional bankers, they were builders. They knew that startups don't operate like corporations. They burn cash fast. They pivot constantly. And they need partners who can move just as quickly. What began as a post-crisis rescue effort soon evolved into a full-fledged global operation. Today, HSBC's innovation banking arm includes more than 900 specialists operating across the US, UK, Australia, New Zealand, Israel, India, Europe, Hong Kong, and mainland China. In less than 2 years, HSBC effectively rebuilt what took Silicon Valley Bank decades to create, but with a much larger balance sheet and far deeper global reach. And now they're turning their attention to Singapore. Chapter 2. Why Singapore? So, why Singapore? Why would one of the world's biggest banks decide to place a $1.5 billion bet on a country smaller than New York City? Because in the quiet chessboard of global finance, Singapore isn't just another square. It's becoming the most strategic power tile in Asia's innovation game. Let's start with geography. Singapore sits at the crossroads of the world's fastest-growing economies between India's rising tech sector, China's manufacturing powerhouse, and Southeast Asia's booming digital market. That's a region with over 600 million young, connected consumers and a startup scene growing faster than almost anywhere else on Earth. To a global bank, that's not a market, that's momentum. But here's what makes Singapore truly unique. It has what Silicon Valley lost: stability and trust. No political chaos, no surprise tax moves, no sudden regulatory crackdowns. In a world where capital hates uncertainty, Singapore offers something rare: predictability. Over the past decade, the city-state has quietly built an ecosystem where money and innovation can coexist. Startups here get global access, world-class legal systems, and zero-nonsense bureaucracy. The government actively co-invests in innovation through funds like Temasek and EDB, and it offers deep tax incentives for R&D, fintech, and biotech. In short, It's one of the few places where regulation and innovation actually work together, not against each other. So when HSBC says it's committing $1.5 billion to its innovation banking division here, it's not random, it's strategic. They're betting on the idea that the next generation of global startups won't be born in Silicon Valley, London, or Berlin, but in Singapore, Jakarta, Bangalore, and Ho Chi Minh City. And Singapore sits right at the center of that map, as the safe financial base connecting East and West. It's the one place where American venture capital, Chinese tech founders, and Middle Eastern sovereign funds can all park their money without worrying about politics. That's what HSBC's global head of innovation banking, Dave Sabo, meant when he said they're working with the most liquid part of the global economy. Tech money moves fast, and Singapore is where that liquidity flows next. Chapter 3, The Hidden Strategy. Here's where things get interesting. HSBC isn't just throwing money at startups, it's redesigning how banks interact with innovation itself. Traditional banking was built on one simple rule: avoid risk. You lend to companies with steady cash flow, predictable income, and long-term assets. Startups are the exact opposite of that. They burn cash, they pivot constantly, and 9 out of 10 fail. To most banks, that's financial suicide. But HSBC's innovation division is flipping that rulebook on its head. They've created their own credit policy, separate from the bank's traditional structure, one specifically designed for these so-called cash-burning companies in sectors like tech, healthcare, and biotech. Instead of running from volatility, they're engineering systems to manage it. In an interview, Dave Sabo, HSBC's global head of innovation banking, put it this way: "We're working with the most liquid part of the global economy. When you think about the capital being raised in technology, when you think about the IPOs that are happening, our balance sheet is a great, stable place to park that capital." That statement reveals the real game plan. HSBC doesn't just want to fund startups. It wants to own the infrastructure of the innovation economy. By offering stability in a world of constant uncertainty, it positions itself as the vault where the world's tech money rests before its next big move. Think about it. As venture capital firms chase the next AI unicorn, as biotech startups race to cure the next pandemic, all that capital has to flow through somewhere. HSBC wants to be that somewhere, the quiet giant sitting at the center of the world's innovation bloodstream, and the results are already showing. In just the first half of this year, the bank's innovation arm grew its active clients by nearly 60%, with deposits up 50% and loan commitments rising by about 25%. That kind of growth isn't luck, it's strategy. A deliberate pivot from traditional banking into what could soon become the dominant financial model for the next generation of innovators. Chapter 4, The Numbers Tell the Story. Sometimes numbers say more than press releases ever could. And in HSBC's case, the numbers are stunning. In just the first 6 months of this year, its innovation banking arm reported growth most banks can only dream of. Active clients, up nearly 60%. Deposits, up 50%. Loan commitments, up roughly 25%. That's not normal. That's exponential. And it's happening inside a division that didn't even exist 2 years ago. To put that in perspective, during the same period, most traditional banks were shrinking their exposure to startups. Tightened lending, higher interest rates, and global economic uncertainty forced them to pull back. But HSBC did the opposite. While others retreated from risk, HSBC leaned into it, betting that innovation, not austerity, would define the next decade of growth. And that bet is paying off, because in this new financial era, it's not about who has the biggest branch network. It's about who has the most adaptable balance sheet. HSBC's decision to treat startups not as liabilities but as future assets is already changing how money flows through the global economy. Every new client, every deposit, every loan in this division represents a shift in financial gravity from west to east, from old banks to new innovators, from Silicon Valley to Singapore. What we're witnessing isn't just a success story, it's the early signs of a global financial transformation, one that's quietly being led by a bank most people associate with traditional finance. And that's exactly what makes this story so surprising. While everyone else was watching Silicon Valley burn, HSBC was building the next one. Conclusion. When Silicon Valley Bank collapsed, most people thought it was the end of an era. But it wasn't an ending, it was a reset. A reset that opened the door for new players, new systems and new centers of power. HSBC saw that moment before anyone else. By rebuilding what SVB left behind and planting it in Singapore, they didn't just save startups. They created a new model for innovation banking, one that connects the world's capital with Asia's fastest-growing ideas. Singapore became the perfect launchpad, small, stable, and globally connected. It's where money from the West now meets innovation from the East. And that $1.5 billion investment. It's not just about lending, it's about claiming a front-row seat in the next wave of global innovation. If the 2000s belonged to Silicon Valley, and the 2010s to Shenzhen, then the 2020s might quietly belong to Singapore. Because the next great innovation story may not be written in California, but right here, at the heart of Asia's new financial network.